Hello and welcome to Banking the Future, a series of special discussions that delve into the ongoing evolution of financial services in Nigeria, in partnership with Union Bank, as the lender commemorates a century of banking business in Nigeria. I am Wole Famirewa. On today's program, we examine traditional and unconventional approaches to funding businesses. We intend to discuss everything from de-risking entrepreneurs to the role of regulators and intervention funds. Joining me to address these issues is a great panel of operators in Nigeria's financial sector. Obiora Madu is the CEO of Multimix Group. Muda Yusuf is the Director General of the Lagos Chamber of Commerce and Industry. And Kunle Shonola is the Executive Director in charge of commercial banking at Nigeria's Union Bank. Gentlemen, thanks so much for joining us today. All right, so I'd like to start with you, Kunle, and if you can just reflect on the impact of the macro environment, because at the end of the day, it really starts with the business environment that you're providing finance to. Obviously, Nigeria is experiencing a very significant economic downturn right now. Your thoughts on how this impacts funding and the strategy of providers of funds to businesses today?
Yeah, thank you very much. As you have said, it's been a challenging maybe 18 months in Nigeria now. The year to date, things have started to improve. But when you look at those kind of challenges that you face, you would understand that funding would become an issue for, first and foremost, in an environment, in an inflationary environment, you would expect that consumption and the ability to save becomes challenged. And if the ability to save becomes challenged, you would expect that also banks' availability or access to pull off savings to fund businesses becomes an issue. In that environment, you have to then think of two things. One is the safety of the funds as financial institutions that you're going to deploy. And the second one is to now look at the categories of people that you want to give those funding to. Under those circumstances, the smaller player, given their risk profile, tends to be the one that suffers either by way of no access to funding or increase in the cost of funding, which you get to see. Economically, things are improving, but if you also look at the manufacturing sector, a lot of manufacturers that hitherto used to have 2, 3, 4 cycles of trade in a year are now, down to maybe 1 or 2 because of the access to FX, which has improved tremendously. But at the initial stages, there was a massive impact on their businesses on that. So funding has been a challenge. If you look at the interbank rates, that has also gone up significantly, and that is a proxy for the access, or for the availability of funding and the ease with which it is available in the industry. So it's been a challenging few months, and I think we are beginning to see some stability. Hopefully, this situation continues.
Dr. Madu, you obviously interact with a wide variety of businesses. Your thoughts on how the macro story is impacting their access to finance today?
Well, I think even before we went into this challenge that we are in, the SME had always been the whipping child in this thing, just as he said, because of the risk profile. So it's either the rate is higher or they are left out completely. So, and I think also everyone says SME is the engine room of the economy. But then, of course, when the SMEs are not funded, then it means that the economy is losing out the benefit that should have come from them. I don't blame the banks, really, because I think there's a lot more that needs to be done, particularly from the regulatory side. I mean, some form of fallback position for banks because of the risk profile of the SMEs, of course, as they do in other countries, that people attend some courses recognized by government, then a certain level of funding is provided. If anything happens to that business, the government takes 80% of it, and the bank bears only 20%. At least when you have such a provision to protect the bank, because the banks are dealing with other people's money, so you don't expect them to just throw it away that way. So, of course, the macroeconomic situation we find ourselves now worsened the situation from what it was in the past. because even other sources, whether intervention or the other, is still not getting down to the root where it ought to be.
Muda, you obviously represent a very important trade group in Nigeria. What's been the experience of your members in terms of accessing funding in an economic downturn?
Well, it has been a very difficult thing because accessing funding is a function of the perception of risk by those who are making the funds available. And the macroeconomic conditions that we went through in the last 1.5 years have been such that has aggravated risks. You know, all sorts of risks, inflation risk, foreign exchange risk, policy risk, security risk, all manner of risk. And once you have that kind of situation, and given the kind of financial system and the financial institutions that you have, they are very risk averse. So for that reason, funding for many businesses has been very, very difficult. Right. Of course, depending again on the risk profile. The risk profile typically of the SMEs are very high. The risk profile of businesses in the real sector are also very high. You know, so that those particular sectors have been particularly challenged in the current circumstances. And to make matters worse, because the banks also have this window of investing in treasury bills, investing in federal government bonds, that has also reduced their desire and commitment to expose themselves towards this form of risk. So that has even worsened the situation of access to risk.
I think you make an interesting point.
These are dimensions.
Right. And I want to take this to Dr. Madu. The point he's made about the risk aversion that we're seeing in the banking sector and the opportunities that they have to invest potentially in much less risky instruments. Do you get the sense, and many have criticized the banking sector for this, that they are not creative enough and they're not bold enough to engage the real sector enough?
Absolutely. I used to be a banker, so I have an idea how it works. But the truth is that we must get creative if we want things to work. Because if we stay on the traditional lending, let's say, for example, we've had situations where a lot of funds have been provided for SMEs here and there. You find out that the same reasons for which the funds were set up will be the reasons that are given why the funds were not accessed. So somehow there must be some level of creativity. And then you find out also that banks are simply looking for guys who are doing well. But they need to get down to get people who have potentials and help to bring them up. I mean, so that they can become their clients. I'll just give you an example. In the export sector, banks will be calling me and asking, they want clients who have foreign exchange to sell. But someone funded the transaction for the foreign exchange to come. So you can't just pick it up like that. You need to pick up guys who have potentials, work with them, and then invest in them, and then you reap the reward at the end of the day.
But is that typically how it works in other parts of the world? And Kule, maybe you can speak to maybe the peculiarities of the Nigerian environment. Because incidentally, I was looking at what's happening in countries like Morocco, where the government is taking a very strong leadership role to ensure that the environment is ripe for a lot more lending to small businesses in particular.
Thank you very much. You know, I didn't know that this was the plan, that I should be the whipping boy. And, you know, in a lot of ways, I think everybody's perception of their reality kind of helps to showcase what you feel your problems are. You know, if you were to talk to the banks, they would tell you that the provisioning regime in the banks, according to regulations, are very clear. You know, under those circumstances, the regulator also expects you to adhere to certain practices within your risk management framework, which makes it difficult for you. And you made a point. You said it's other people's money. So right. All of these things make it difficult for you to want to be like to want to do a CSR kind of activity, which is to say, I know it's important for us to grow this sector of the business, but that sector must be grown within laid down rules, policies, as guided by the rules that I'm operating under. You have talked about Morocco.
Yeah.
In several countries, and I think this is one of the perceptions that we have to correct, there are different kinds of capital that is required for different levels of business. If you use debt capital to finance, say, where equity is required, there will be a problem. And I think sometimes, most of the time, there's a default on banks to provide equity capital for startup businesses rather than debt capital to catalyze the business from where they are. So sometimes we tend to get the feeling that everything is the bank, the bank, the bank. The bank has a defined role. All the there are institutions that have been created to energize capacity for businesses. And in this environment, maybe some of the things we want to do. And you know, when you look at the Nigerian story, you would see that we have several enabling organizations and bodies. In life, the challenge has always been how effective has this body say that they don't exist. Is not to say that the charter that set them up did not specify exactly what they're supposed to do. But in as much as banks have even come to feel, you know, a lot of the role and the vacuum that has been left by some of these organizations, you know, there is a limitation to which banks can do it because they operate under a regime that is regulated. Right.
And you know, I think we're talking about unconventional approaches to fixing issues here. And so I do get the sense that the environment, rather the players in the environment need to adapt to that environment. For instance, we are seeing a lot more banks really getting very close to small businesses and trying to begin that de-risking process by educating them, by training some of the people that they would potentially lend to, and being in the last, say, 2 to 3 years, a lot more aggressive in engaging small businesses. Mr. Madu, I want you to speak to what you're seeing in the environment today and the peculiarities, which I think he has spoken to a large extent.
Yeah, let me, I agree with him. The whole idea is actually not hitting the banks, but the point is that they have a role to play. But he made a point, actually. The regulatory bodies, because they're operating under a very tight, restrictive environment. Yeah. The rules are there, and you have to keep it, otherwise the hammer comes on you and the rest of them. But then how do we survive? You are talking about, okay, what banks need to do, like you just mentioned, is to engage with the SMEs, or even the manufacturing. You can de-risk by even training, getting a group of people, clients, to train them along one area for them. The fact that they have good knowledge of what it is that they are doing. Because, you see, part of the challenge is actually not just banks. Because at times we just blame the banks. But the fact is that even people who are coming to borrow money are not even ready for it. No proper business plan. The projects are not bankable. And yet we want banks to fund it. So, but banks can help people who have potential, but the proposals they have and the transaction is not looking bankable. Can help them through one way or the other, maybe by educating them to make those particular projects bankable. At least that become, because if you do that if all the banks take out 10 people, make them bankable, and put them to the pool, I'm sure it will, the multiplier effect will be huge for the economy.
Okay, you mentioned perhaps several banks taking a set of people, but could there be a more holistic solution? We've seen, for instance, in Nigeria that the banks have come together to address issues relating to IT, relating to credit risk. Maybe you can speak to this point.
My perspective.
Are the banks working together, or are they working in silos to address these issues that they are facing?
Well, they work together when it is convenient to do so, and they go separately when it is convenient to do so. But you see, in this whole discussion, we need to separate what is a development objective from what is a commercial objective. The banks, the commercial banks in particular, their primary objective is commercial, is profit maximization. If you want to align them to the achievement of a development objective, i.e., funding SMEs, funding the real sector, you have to do something much more to bring them into that space. And that is the responsibility of the regulatory institutions and the government. Because the whole idea of bringing the financial system to support the development objective, we are talking now about job creation. We are talking about poverty alleviation. We are talking about inclusiveness. You need a particular policy framework to make that happen. Because if you don't have specific policies to de-risk lending, especially to targeted sectors, we not get anywhere. We've had so much of intervention funds.
And we'll get to
and yet we cannot access it. Because the policy is that the banks bear the credit risk. So if you are bearing the credit risk, why must you let down your guards? So this is a development issue. Right. So for all the critical sectors, because we also have enabling environment issues. Right. Because it's the enabling environment sometimes that aggravates the risk of default. I mean, if you have to be battling with power, battling with rules, battling with the ports, battling with customs, battling with the tax officials, it increases your risk. And as your risk increases, the chances of default increases. And the banks, of course, naturally will stay away. So we need to critically address the issue of de-risking the environment across sectors.
Do you want to react to some of these points?
I think it's important, in my view, to actually make some follow-up comments. First and foremost, if we cast our mind back to some time in the past when banks set up this SMILE scheme, where a percentage of their profits were invested in small businesses. First and foremost, let us understand that, in my view, the role of a bank is actually to create wealth. If you don't create wealth, to a large extent, you will not have a vibrant set of customers to bank. And of course, the future potential of that financial institution becomes challenged. So that was there. But the banking industry and the banking community is just one subset of what is required to make business successful in this environment. You mentioned, I interact with clients on a regular basis. The kind of problems they come up with on a daily basis would even surprise you. From, tax audits from different scales, different subnationals, from local governments to there. You have that. You have, the usual power problems on which in the manufacturing environment, you cannot tell prior to now that this is how much diesel will cost. You have to produce. Your diesel cost can go up by 10% in one day, but you still have to produce, but you cannot increase your cost, your price by 10%. And so you find out that there are several levels of challenges that needs to be solved. What has always been the issue is which ones are the national priorities? And is there an action plan to say, listen, something as simple as a database for addresses is an issue. Because if I want to look at an SME and say, you're there today, you're there tomorrow, I need to be able to, because you have already agreed that in terms of collateral management for SMEs is a bit fluid. So I need to be able to verify who I'm lending to. And you talked about banks. If you look at today, many banks organize a lot of training for SMEs. Some are 6 weeks, some are 2 months, some are boot camp type training. So the banking industry is doing a lot to ensure that this happens. A lot of banks today also have, staffed SME desks whereby they are able to provide advisory services to SMEs when they come. There are banks that have desks where you can even go as far as to help with business plans and all of this. All of this in response to what we see to be the challenge. We would love to bank as many people as we want. We love inclusion. Inclusion grows the industry. You know, so to a large extent, we are willing, the banks are willing to do as much as they can. And you go and look at how much the banks have lost in pursuing, you know, these obligations. You know, but the banks have not stopped. They continue because they believe ultimately a stronger industry, a stronger manufacturing and trading base will be a stronger economy.
No, very strong point as well. And I think you make a very interesting point about the importance of records keeping to assist the process. And this brings me to a point around the role of technology in this process. And looking at the type of trends we've seen in other parts of the world, China, for instance, we're seeing a company like Alibaba becoming a commercial lender today. And one of the reasons I think that is enabled is because of the electronic footprint of the people that they are dealing with. And maybe you can speak to this point, Dr. Madu, your thoughts on how technology can assist this process.
Well, of course, the database which you mentioned is technology driven.
Sure.
That will help because as a country, even now, national ID card is not a success in the real sense of the word. Yes, a lot of people have ID card, but a whole lot of people also do not. So if you can't trace people, it is difficult to do transactions with them.
And of course, companies too.
And looking at it from the technology point of view, do we really have the technology to drive this in the country? It's not rocket science. It is possible. But the fact is that, like Muda mentioned, what is the policy direction? Is it an area of interest to us? If it's an area of interest, it is something that is achievable. Banks have, have improved a lot technology-wise. They can match other banks elsewhere in the world. But the point is that on the other side, is that form of improvement also there? The answer is no. From the government side, because even though people like Bureau for Statistics, there's a massive improvement from what it used to be, but other area of biometric information keeping and the rest of them, we don't have them, and it's very difficult. Tracing people is a problem. Even in the commodity business, someone says, let me have the money, return in 2 weeks' time to come and collect the commodity. By the time you come, nobody lives in that place any longer. So that's actually an issue. But I think an improvement in technology would do a lot.
Right.
And technology, helps efficiency. It makes businesses more efficient and more profitable. And that is one thing, again, that we need to worry about when the regulatory authorities come up with guidelines on who to lend to and who not to lend to. There is this fixation that, okay, it has to be manufacturing, it has to be agriculture, without necessarily profiling the productivity of sectors. Some sectors are generally, given the kind of environment we are in, some sectors are more productive than others.
So which sectors do you think are being left behind now in your estimation? In
terms of productivity, manufacturing, particularly at the SME level, the productivity is very low. The same thing with some levels of agriculture, particularly at the primary farming and level and all of that. At the level of processing, of course, some issues of productivity. But the service sector productivity is much higher. So when the regulatory institution insists that you must give 60% to this, give 60%, you need to look at the sectors that can also give you quicker returns. Not just about money, even about jobs, about sustainability, about revenue, about all of that. I've seen a lady, she's into sewing of dresses and all of that. She heard about the intervention funds. She went to the banks and she was told that, no, it's not for people like you. It's for manufacturers. She was shocked because she's adding a lot of value to the dresses that she's sewing. So we need to also change our mindset. And we need to also understand the economy that we have. We need to focus on areas of the economy where we have very good competitive advantage.
Right.
It is easier to push in those directions, and the economy will get more value, rather than knocking your head against a particular sector where all sorts of issues are constraining the progress and productivity in the sector. I think it's very important, which I think is a regulatory issue, I think.
We'll certainly talk about the role of regulators. I do have to take a short commercial break right now and continue our discussion on financing businesses right after the break. Do stay with us. Welcome back to this special panel discussion on funding large and small businesses. My guests are Obiora Madu, the CEO of the Multi-Mix Group. Muda Yusuf is the Director General of the Lagos Chamber of Commerce and Industry, and Kunle Shonola is the Executive Director in charge of commercial banking at Nigeria's Union Bank. Mr. Madu, I want to speak to you now and I want to get your perspective on a point you made very earlier on in this conversation about the fact that there are several pockets of financing that businesses need, and bank financing is just one of several. Your thoughts about how we can develop the other segments, so the angel investing, the venture capital, the startup capital that many businesses need. Your thoughts about developing that aspect here?
Thank you very much. The truth is that the enabling environment, which had been mentioned earlier, is an issue, no matter the type of financing that you decide to adopt. Looking at venture capital, it's not really, I don't think it's very well developed here the way it is elsewhere. But let's even go back to the SMICE funding.
Right.
Because that's a fund
for SMEs.
Yes, for SMEs. I am not sure if that very particular intervention paid off very well, because the truth was that so many people were not able. There were some organizations that benefited from it and did very well, and after a few years the banks pulled out and they are still doing very well today. But that was an intervention fund. It was like a one-off thing. Now we're not talking about SMICE again because that one is over. But it is something that will require on a regular basis. And it will require like a policy framework that will make... See, it's like when one of the former presidents, he said when he came in, there were about 66 poverty alleviation agencies. And yet poverty was increasing every day. He also mentioned about the agencies, particularly, let's say, development banks, a whole lot of them. I think we've even added more. Recently, we've added more. But the point is, do we ever measure anything in this country? What I'm saying is that at some point, we sit back and say, this organization, we've given you so much money, these are intervention funds we provided. How many SMEs have been made out of this? How many SMEs have progressed, have increased production and everything out of this very particular funding? So I think one of the major issues is actually in the regulatory side. I'll give you an example. In the export side, there is an export credit guarantee scheme, which was part of what was when Nexim came into existence. You remember the name was Export Credit Guarantee and Insurance. That was the original name before it adopted Nexim. Now, the purpose of that very particular guarantee is to become a fallback position for banks when they run into issues with export this thing. Since, I think, over 20 years now, that very particular fund has not been funded.
Right.
So it is there in paper. In Nexim. So
a
lot of the challenges are actually coming from the policy side, because there's a limit to how much banks will do. The situation is very, very tight for them. So if it is possible to speak to those who are in a position to touch up these policies, look at realities on ground, look at the peculiarities of the environment, and then change policies, make life easy for those who are lending the money, provide fallback position for them. Look at this export stimulation fund, you are giving the bank like 3% out of the 7.5%. And the bank is carrying 100% of the risk. How do you expect the bank to leave other profitable transactions and come and do that when there's no compulsion for that? So that's the way I see it.
Let's speak to a banker to get his thoughts on the use of these intervention funds. Kunle, your perspective on this. We've seen quite a bit committed to supporting particularly small businesses. Your thoughts on how we can get a lot more from these commitments?
Well, over the years, there's been quite a slew of intervention funds. First and foremost, you must know that the regulator has tried, really, seeing the challenges in the industry. That's what has led to the creation of these intervention funds. And also, if we could measure what the intervention funds have done, a lot of companies have also benefited. In the power space, I remember there was intervention fund in agriculture now, and in aviation and all that, whereby the intervention has helped to stabilize those businesses. I'll tell you, and when you said, banks have actually done a lot. I mean, in our case, 100 years old, everybody knows that Union Bank used to finance and still finances agriculture.
That's right.
Even when agriculture was a challenge for any other bank to go into. The bank stayed the course and still continues to support that industry till today. There will be some challenges there, but if you understand it more and more and more, you stay with the program. I think a lot of the intervention funds have benefited industry. The issue, which we have not considered, it's a large country. It's a lot of people. And if we say 170, 180 million people, I mean, you need to think about the number, 180 million people. So given the finances of the country itself, how well can we leverage it for the totality of all the people? So it's important that we rapidly create wealth such that, we can have the capacity to finance, productive endeavor. Because there are a lot of people. And even if the intervention funds get up to 20% of the population, 20% of the population is still 36 million. There's still a lot of people that, so the kind of investment that you need is also a scale that we have not considered.
Does you want to react to this?
Yes.
Because I know many of your members are unable to access this fund.
Yes. You see, on the intervention fund, it is also important to have the kind of framework that will enable the intervention funds make the right kind of impact. I agree with what he said. I mean, when we look at what kind of financing gaps you want to address and the available funds, I mean, it's still a token. But even the token that's available, are we fully utilizing them? I don't think that for as long as we have a framework that makes the bank to bear the risk of intervention funds, that is a major problem. Because it makes access to those funds very difficult for a lot of people, especially for sectors that are perceived as very high risk. And unfortunately, it is these sectors that actually can generate the kind of employment that we are talking about. The kind of jobs, the kind of growth that you want to drive. It is these sectors. Unfortunately, they are very risky sectors. And if the banks will have to bear the credit risk, they will shy away from some of these sectors.
Sorry, can I challenge you, actually?
So we need to look at the framework of the intervention funds as it is today.
Okay, Kunle wants to react to this.
No, I wanted to challenge him, and sorry about that, because, I actually think we should look at it differently. All the time, we look at the traditional sources of finance, and we say the banks. Lagos State Chamber of Commerce and Industry, what have we put together to say we have identified 5 priority industries or segments or industry segments, and we know what their challenges are, and we are going to capacitate them. We're going to create capacity for them to approach, a financial institution through partnership, which is to say, Lagos State Chamber of Commerce, twins with Union Bank to say, for this particular industry, I, as Lagos State Chamber of Commerce and Industry, I will ensure that my members get the necessary learning, the necessary advisory services from the chamber to ensure that by the time they're approaching the bank, they're actually coming with something that is bankable. That way, we begin to change the discourse.
And beyond that, I think if the chamber can also incentivize its members.
Let me react.
Okay, let's hear what you have to say on this point.
I used to be the chairman of the export group of the Lagos Chamber of Commerce, even though I'm not here in that capacity though. But we did exactly that. What we did was, first of all, start building the capacity of members of our group. We invited banks to come and make presentations. And what we're saying is that when we say these people are ready, indeed they are. Because the group is in a position to help them fine-tune their business plan, help them also develop the proposal to the bank, because we know what the bank is looking for. So that's one way. I'm talking about the one I know. But I also know that almost all the groups in Lagos Chamber of Commerce are doing some similar things. The only question to ask is, like you said, have we approached a bank? Maybe at the end of the day, we will approach Union Bank, but I know that we have done quite a lot in that direction.
See, let me say this. There are some of these variables that are not within the control of even an institution like the Lagos Chamber of Commerce. Because we talk about enabling environment variables.
Sure.
That is why what the government is doing at this time is very important. Addressing the issues of the enabling ease of doing business. Because many of these issues are issues that can only be addressed at the governance, political governance level. There's a limit to which either individual corporate institutions or associations can address some of these things. And these variables impact on access to finance. So I think it's important for us to also understand that there are quite a number of variables that are exogenous to institutions like us, to the businesses themselves, which impact a lot on access to finance and the risk.
I wanted us to talk about smart thinking about the risk in business, and I think you've led that conversation with what you've said about what the group in the chamber is doing. And I think that is perhaps the future, how trade groups can come together. And maybe you can also speak to your experiences dealing with trade groups within Union Bank. I believe that there should be a way to incentivize those members to stay the course with the group and, of course, with whatever financial institution they're dealing with.
That I would even talk about my experience in another part of Africa, where one of the development agencies of one of the European countries actually set up a hub, where in that hub you had a financial advisor, you had access to internet, laptops, they would help you review your business plan and all that, and package it for funding. You are allowed to use that particular hub for 3 months, within which, so hopefully by the time before you get in, you're as near ready to, laying out your plan and getting funding and all that. And it's been successful in that part of the world. It's in Africa, so that is also something that, in my view, pressure groups, because you talk about enabling environment. Government is working very hard on the ease of doing business. But that ease of doing business, as I have seen, the Vice President has been in consultation with so many industries. I think last week it was the aviation industry, manufacturing and all that. The ease of doing business is actually taking feedback from the people who are participants in the industry. And it is that feedback that enables you to, calibrate what to do. So I believe that the businesses themselves are a pressure group. After all, in another 4 years, I'll come to you to say, vote for me. So to a large extent, industry also needs to organize itself differently which to enable them have access to funding. As a pressure group, even banks will recognize, nobody would say, Lagos State Chamber of Commerce, I would not deal with you. Because banks understand the power of industry under one umbrella. You know, so for me, maybe we also, within industry, recognizing the limitations of the banks, start looking at how creatively together we can come up with new ways of doing business. But for me, the more knowledge, the more diligence, the more that people put in terms of coming up with their business plans, testing those business plans against environmental factors, testing those business plans against the risks that we see and the ones we cannot see today but can foresee, the better it will be. If for example, my NPL ratio goes significantly lower, it improves my ability to lend more. So if industry is giving me people I can lend to who are much better in quality, not because they have money, but because they have knowledge, then it increases the bank's ability to do more. Because then these risks that people claim banks are running away from, they won't run. That's
very
now,
useful contribution.
Yes, about ideas on how to de-risk coming from businesses. You see, this concept of clusters, could also help a great deal. Because one of the challenges that the SMEs in particular face is the challenges of poor economies of scale. But where they are encouraged to come in clusters, they're able to share quite a lot. Purchases, facilities, power, and all of that. And that also helps to drive down the cost. Then secondly, it is important that the government also establishes a very robust credit guarantee institution. It is very important.
Do you agree
that is
that
very
is
important.
An imperative that the
Yes.
government needs to really provide that extra level of credit enhancement for every lending that we want to see the banks?
Yes, of course, because if you look at the environment, it's very challenging.
It's just
very, very challenging. I gave you the example on the export side. That was just export. But even the normal lending also requires some level of guarantee to make life easy for everyone. Because if life is easy for the banks, then obviously they will make the money available to the SMEs.
And this is what happens in countries like India. You have a whole bank in charge of guarantees.
We've seen the central bank lead the way a lot in terms of that intervention into what is called the Anchor Borrowers Program, which we've seen really drive lending to smallholder farmers, and we've seen very dramatic increase in yields. Right. And from what I gathered from an interview I had with the agriculture minister, as much as 50% of those loans are already being paid back. So it seems to be working pretty well. And you mentioned that Union Bank obviously has been invested in the agriculture space for a while. How can we take such initiatives to the next level? And how do we now begin to tie in the traditional banks into this?
I think the first thing to understand is that as a financial institution, if business is sustainable, it's in my interest to lend to it. So, for example, in the case of the Anchor Borrower Scheme, you can see where the money will come from. And if the farmer continues to see those yields and continues to monetize his sweat, of course he will continue to farm. Because it's when you have disruptions to industries, that is when, then we are now talking about risk, everybody's running away and all that. But under those circumstances, you can see the success of that because there was focus. There was policy to back it up, and there was clear focus in terms of who does what, and it's sustained. Agriculture is is a very priority program for the government. So I think we can't do every sector, but we can look at which sectors contribute to GDP, to employment, to poverty reduction, and to inclusion. Which sector pulls people out of poverty and gets them, self-funding. And then we look at, replicating some of these issues. I don't disagree with you that maybe some of the rules might hamper, access. But don't forget that some of those rules were left there, were put there to guarantee the long-term sustainability of those funds themselves. Because if we all access the funds and we don't pay back very quickly, and we know several examples of that very quickly, it becomes a problem. So if there are instances where those rules can be, through industry, through interactions, we can say, listen, these are some of the things we can do. For example, in the Lagos Chamber, for example, some of your members have been there for 40 years. So we know who will disappear, who will not disappear. So there might be, I think, an opportunity. Right.
You just made a very interesting point, which leads me to how the regulators can enable this process. Now, we know typically the regulators they want to see collateral to protect the depositors' funds and so forth. Can we see more flexibility there? And I want to get your perspective on this, Dr. Madu.
You made a point. Even the lending institutions need to understand the transactions very well to be able to fund it. That's actually where collaboration will come in. There are certain types of transactions where there's an issue, because this is a situation, you find a situation where it's like throwing the baby away with the bathwater. So I think that, because if you look at agri-value chain financing, part of the biggest challenge is that the financing institutions do not really understand the pain that the people down there are going through. So I think that if they understand, it will help to better structure facilities. It will help flexibility, which you mentioned. Like the anchor borrowers scheme, which you are talking about, there's actually a state, the lower echelon, which is the 500,000 and below, they got 85% returns the first time. So I think people are not, generally people think that everyone in business is doing one crooked thing, but the truth is that a lot of people don't go into business for that purpose. Circumstances, enabling environment, a whole lot of things can just derail a business, an honest business. So I think understanding on both sides will help flexibility.
But my guess is that if we add the credit enhancement, can we now allow a little more flexibility? But
just to also make this point about the regulating institutions and the government. What we have seen in the past few years is the government crowding out the private sector in the financial markets. And that's a very big issue. If you look at credit, private sector credit to GDP in Nigeria, it's one of the lowest that you have, even on the continent. We have a situation where the government is borrowing more from the financial system than the private sector. And it's because of all these treasury bills, government bonds at a very high rate. So if you want to compel the financial institutions to also be more creative, the incentive to invest in treasury bills and government bonds has to come down. That will challenge them to be more innovative, to be more creative, and to relate more with entrepreneurs. Because business is about risk. And the banks cannot afford to run away from risk if you want to move this economy forward. That is one. Secondly, it is also important that the regulatory institutions also incentivize lending to the growth sectors of the economy. Now, I was at a particular bank. They are very good in lending to SMEs. I said, are you even getting any incentive? And he said, nothing. So if you expose yourself to the risk of lending to SMEs, you are on your own.
Which is the credit enhancement that I spoke about.
Yes. So we need to also have a framework to even encourage the banks that are lending to SMEs, lending to agric, lending to manufacturing. So that at least they feel that, yes, if you do this, you are not just doing it just for the sake of maybe nationalism, but you're also getting some benefits from doing it. It is important.
And in terms of distributing financial services, I want to hear from you in terms of that point. Because technology, as we mentioned earlier, is enabling a whole lot today. Many people can initiate financial relationships, which include lending relationships as well. Your thoughts about how that is evolving, and maybe you can speak to what Union Bank is doing in this respect too.
You know, clearly there are opportunities for technology, to use technology to even leverage, even on the lending side. In other countries, probably developed countries, mostly out of West Africa, outside of West Africa, you could actually, you don't have to go to the bank to apply for a loan and to get the loan disbursed. It is possible for all these transactions to take place in less than 10 minutes from application, from a remote location, which is maybe online, or for you to do that. And a lot of that also still rides on the fact that there is predictability about behavior. What is lending? Is giving you money because I can predict your behavior. I can predict and say to you that I know he will pay me back, all things being equal. Where there are issues or circumstances, I can understand. But those will be maybe less than 5% of these circumstances. So there's opportunities to use technology, but also, I mean, if you look at cocoa farmers and all that, technology allows you to get online real-time information about cocoa movements and prices and all that. So technology has changed some of our industries. You raised something about the credit guarantee scheme. I think one of the biggest challenges we've always had about that scheme is who do you rely on? When I say who do you rely on, a lot of people have farmlands that have been in their families for generations. So why don't a government agency take those farmlands as collateral and then give a guarantee to a bank? And then I can lend to the guy maybe 50, 60, 70%. If you even do that alone, you would unlock a huge amount of capital. If what the guy has is something that the banks do not consider to be tangible collateral, why can't that agency take it on, and on the back of that, issue a note to a bank to say, okay, fund up to 50% of this. And that becomes a national, it could be a land bank, it could be a national asset register, but at least you can use that. You have unlocked, we have a lot of wealth that is lying around. You have unlocked the wealth by using it to start a business or to fund a business. I
really like the idea you're bringing out there, because as you mentioned, there's so much wealth in the country. We can use that to unlock lending. Mr. Madu, do you want to share your perspective on this point?
Yeah, I think the point is that character is a major challenge that the banks face with people who, I mean, I saw it when I was on the other side. There was a particular facility which was government guaranteed called ADB Export Stimulation Loan. That was in the early 90s. And everybody treated it as if it were a national cake. 41 factories were set up from this facility. But as I speak to you, not a single one is functioning. So really, issue of character is very, very important. And then, because if you are very sure, because just like he said, if the agency takes the property and gives some level of guarantee to the bank to lend, the bank will comfortably lend. Of course, doing the normal due diligence, but knowing that there's a fallback position. And part of the major risk there is still that character thing. So I think people on the business side also need to show a lot of transparency. And then this lack of data is also one of the reasons why someone can default in one bank and move on to another bank to go and take money. So
I think the BVM system, which is one of the things I think have come out of collaboration in the financial services sector, is obviously helping to address
that direction. Yes,
right. But if you can speak, we've spoken so much about SMEs today, but they're also the large corporates, and they have their own circumstances as well. Your thoughts about your experience at the LCCI with large corporates and how the environment is changing for them?
Well, for the large corporates, generally the financial institutions are more comfortable with them. You know, they are not seen as risky.
So the issue for them is more of price? Is that what you're saying?
Yes. They are more comfortable.
Because they have assets.
They have assets, they have track record, and the cost of administering credit to them, compared to going to administer credit to 1,000 SMEs. You know. So I think they are generally more comfortable, and they have first the advantage of economies of scale.
Sure.
So which in most cases also help to drive down their costs. You know.
Right. I'm running out of time, but I wanted you to comment on the large corporates and maybe speak to your experience and how you are engaging them.
To a large extent, it's been a tough year for all. The only thing is that if the large corporates are in most instances more resilient in withstanding some of the vagaries of the economy, the smaller you are, the faster some of these effects would hit you. So we found that a lot of large corporates have also delayed investment decisions in new projects, new areas, expansion and things like that. So I don't think across the industry it's been a challenging time for all. But what is critical is that they're more resilient. And also, if you compare large corporates to smaller ones, they have, more investments in financial reporting. They have a lot of people who work for them, who makes it easier for banks to interpret the information they've been given and make lending decisions. So but it's not generally, it's been, everybody's been hit one way or the other.
As I mentioned, it does appear that their problem is more of the price of the credit, not getting the credit. At least most times that is the case. And on that note, we've come to the end of a special panel discussion on lending to the real sector. My guests have been Obi Aramadu, he's the CEO of the Multimix Group. Muda Yusuf is the Director General of the Lagos Chamber of Commerce and Industry, and Kunle Shonola is the Executive Director in charge of commercial banking at Nigeria's Union Bank. And I am Wale Famariwa, thanking you for watching.